Good Friday morning.
Hey, good morning, Mark. How are you today?
I'm doing well. How are you?
I'm doing well. How's your week been?
It's been a busy week, a lot accomplished, feel good. It's a new reality that we're in, trying to get through every day, every week. But we're here now and happy that it's Friday. Looking forward to a relaxing weekend.
You know, what's interesting is I think for me, my mental transition has been a little bit, yes, I'm optimistic and yes, I'm positive about everything, but I've had to take my thought process and change it a bit to look at everything that's going on today. And I kind of like the one day at a time thought process, which I don't think I ever did before.
Right.
So it's been a little bit of a transition for me. But you know what? I look forward day to day. It is kind of Groundhog Day. I will admit that.
Mm-hmm.
But you know what?
It's not just because we do a morning show every morning, I guess.
Yeah, maybe that's it. I don't know. I mean, now we have 2 days off. I mean, what are we going to do with our, you're going to sleep late. I probably won't, but
yeah.
But we got Frank Dippold with us today at Vandyk Mortgage, the originator of a 3-2-1 and done program. And here he is. Frank, good morning. How are you, Frank?
Good morning, guys. How are you?
Good. Thank you for joining us.
Real well. This is Level Up Today, April 24, show 30.
Is it 30? Then I screwed up. I wrote 29.
Are we Thursday or Friday today?
We're Friday. So then I messed up on the episode.
It wouldn't be the first time I messed up. That's for sure. But anyway, Frank is a VP of sales at Vandyk Mortgage, and I've known Frank for a while. He's got, some really great stuff going on out there. The Velocity of Money, 3-2-1 and done. Frank, good morning. Welcome to the Level Up Today show.
Good morning, guys. Thanks for having me. I'm very excited to be here.
Yeah, we're excited to have you, man. So talk to us about, just jump right into it. Talk to us about the things we're hearing, okay? The new buzzword over the last 7-8 weeks has been forbearance. That's a buzzword. You brought up some things you want to talk about non-QM and what's going on with refinancing and the rates and the volatility. So hit us with that stuff as we move along, and we'll hit you with some questions as we move.
Yeah, two really hot topics. Forbearance is one of them, and to start with forbearance, about a month or so ago, the government shoots first and aims second, and so they go, "Hey, we're going to allow for forbearances," but what they didn't do is they didn't check with the servicers. So for all the people that don't understand exactly how Fannie, Freddie, and Ginnie work, right? There are three government regulatory bodies that govern the loans, and then lenders like ours, who are Fannie, Freddie, Ginnie direct lenders. We write the loans, underwrite the loans, close them, and then sell directly to them.
Right. When
we sell directly to Fannie or Freddie or Ginnie, we have to service the loan unless we go to what they call a subservicer. So the government says, we're going to allow forbearances for up to 90 days without asking the servicers. Now, there's two components to that. When it's an FHA loan, which is also known as Ginnie, the servicer has to pay the principal and interest payments to Ginnie. So the servicer, even though the government says we're going to allow for forbearance, the servicer is still on the hook for all those mortgage payments. With Fannie and Freddie, they're not on the hook for the principal and interest payments, but they're on the hook for the taxes and insurance. So thank you, government, for telling everybody that forbearance is going to be allowed, but you're going to put servicers out of business. So what started happening was servicers started to panic and push the rates up. So there was this battle going on between where the interest rate should be and what the government was doing to buy mortgage bonds to push rates down. But in the meantime, the value of that servicing went down in the bond market because if people weren't going to make their payments, nobody wanted to buy the paper. So it's been a crazy mess.
Yeah.
4 weeks.
So are the banks making, or the servicers making the tax payments?
The servicers have to make, with Ginnie loans, they have to make the full principal, interest, taxes, and insurance.
Okay.
To the government. With Fannie Freddie loans, they only have to make the taxes and insurance payments to the government. So yes, the answer is yes.
Right.
So then there's this guy, Mark Calabria, who's the head of the FHFA, and he was being like totally, not listening to all of the MBA and everybody that was saying, hey, you can't do this. You're going to have to put a fund together for the servicers because you're going to put them out of business. But the other side of that is, and where the public sort of gets a little deceived is everyone thinks it's a free lunch. And normally what happens with forbearance is one of three things is going to happen. You're going to owe the 3 months payments at the end of the 3 months. So if somebody doesn't have $2,400 a month, how are they going to have $7 or $8 grand in 90 days?
Right.
So that's problem number one. Problem number two is if somebody's teetering because they're not, doing that well financially, and they go into forbearance for a couple of months, the likelihood of foreclosure increases because once they get that far behind, they stick their head in the sand. Now we got a problem. But the third thing is, the best case scenario is that it gets lopped on to the end of the loan. So I've said to people on my Facebook Lives is, listen, if you can't feed your family, and that's priority number one, and you have to look for a forbearance, call your servicer. But we have to realize that this mortgage payment's not going into outer space. It's got to be paid back at some point.
Right.
So Mark Calabria finally came to his senses a little bit and put a 4-month window on that forbearance for the servicers, and they're sort of trying to help out a little bit.
What do you mean by a 4-month window? Explain that.
So if the loans go past the 4-month forbearance, so the client gets approved for 3 or 4 months and then decides they're not going to pay it, because at some point the likelihood of them maybe continuing not to pay it is high. It's not going to be everybody, but it will be some people. Then the government will no longer make it the responsibility of the servicer. So say you're a servicer and somebody misses 6 payments. You're on the hook for those payments until you foreclose. And we know in New Jersey, a foreclosure occurs 2 years later. The servicer the whole time would have to forego that money. Now the government's saying that at 4 months of missed payments / forbearance, the government will take it from there, type of thing. So it's a little bit of a mess.
Right.
The silver lining, to be more positive, is, and I'll talk about sort of the battle between what the lenders are trying to do with interest rates and what the government's trying to do with interest rates. The silver lining is rates are ridiculously low. I have 50 people locked at lower rates than I ever got anybody prior to 60 days ago.
Wow.
So ever. I've done $1 billion in loans. So, and those rates are sub 3.5%.
Are people doing that on a 30-year fixed, or we're talking like 7 or 10-year arms?
So arms are terrible because there's an inverted yield curve whenever the 10-year note goes really low. Right. Arms get wacky, so they're terrible. They're actually worse than fixed rates.
Okay. 30-year
fixed rates are low to mid 3s. 15-year fixed rates are in the high 2s. So what I'm doing with a lot of people is taking them either from a 30 to a 30 and showing them how to take the extra payments that they're making on the savings and apply it to principal and shave 8 years off the loan, which then saves them $200,000 in payments. Or if they have a little bit of room, like if they took the loan 5 years ago at 4.5%, and I can give them a 20-year fixed at 3.125%, right? They probably still save $100 a month, and they shave 5 years off the loan, which is $100,000 in payments, and they're golden. A lot of people say to me, hey, can I go to a 15? I'm like, yeah, but you're not going to like the payment. So a lot of times when people have a 30 and they want to go to a 15, it becomes unrealistic. It jumps the payment too much. But a 30 to a 20 is a wonderful strategy. And then if they're doing well, they can pay extra to get it paid off in 15 or 18 years or whatever. Right. So, now one other interesting thing that was crazy that nobody would understand unless you were heavy in the detail is when rates go really low really quickly, like the government had the right intention, and when COVID hit, they panicked with this CARE Act stimulus package. They started buying bonds like crazy. When they buy bonds, rates go low fast. Mortgage people are like, this is great. Rates are low. I'm going to refi the whole world. Right. Love that. Except there's a hedging component to this. And so the other thing that lenders have struggled with in America is, so they sell in bulk or they hedge loans. So say they do a tranche, they call it, at 3 5/8%. And they're planning on selling $100 million worth of loans because they have $100 million locked. But those loans are not closed yet. When the government goes crazy and buys bonds, and all of a sudden the rates are 3.25, what happens is that lender has to pay the short, the difference between the 3 5/8 and the 3.25,
Right.
to the Wall Street trading firm. And what happens is, until those loans close, when they get their money back, they're out of money. So the largest lender in America, we all know who that is, Quicken Loans, got hit with a $1.5 billion hedge bill.
Wow.
Ago. My company got hit with a multi-million-dollar hedge bill. So you have to have the liquidity to cover the short,
Right.
and then you get it back in the closings. Now, if your lock to close ratio is bad, meaning you, out of 100% of the locks, if you only close 60% of the loans, you lose that hedge money on the 40%.
Wow.
So Barry Habib and all the leaders in the industry were writing letters to Washington saying, you have to slow down the purchases of bonds because this kind of thing with interest rates is actually bad for the business. So, and they did slow the bonds down. 3 weeks ago, they bought $200 billion worth of bonds, and it caused hundreds of millions of dollars in hedging losses. So we don't care whether rates go up or down. We only care if rates go up and down drastically. So that was like, an owner of a mortgage company like mine, who's at this point doing about $1.5 billion. If you have to write $3 or $4 million a month in hedging losses,
Right.
how many months can you do that for? So that has stabilized.
So tell me what this all means to the consumer first, and then the realtor doing the business.
Sure. So for consumers, the one silver lining, because obviously, people are very worried and very scared out there. And, my thing is, the silver lining is that interest rates are low. There's $11 trillion in mortgages in America, and 5 to 6 trillion of that will be eligible for refinances. The average loan to value in America is 75%. And most of the people will be able to help either reduce the rate, give them cash flow, or if they have some credit card debt, give them some money to pay off that debt.
Right.
So, whenever there's high government debt, which obviously now, right, because they did all the stimulus stuff, it's going to put pressure on rates to stay low. So how does that affect realtors?
Mm-hmm.
The difference between a 4% rate and a 3% rate, say on a $400,000 loan in New Jersey, is about $400 to $500 a month. So that gives the client more buying power.
Right.
Yeah. So for the realtors out there, I know it's tough right now. We're doing virtual tours and we're doing all these other things, but there will be more buying power to get people approved. And hopefully it's not like 2008 where a lot of people are kind of sitting on the sidelines going, oh, I'm waiting for housing to come down more, or I'm waiting for rates to go to 2%. You can't time the exact bottom.
No.
Give more purchasing power.
Do you believe that that's going to have an effect on price?
Well, so some of
the price of homes. What's your opinion on that?
Yeah. So, I do a lot of forecasting with some of the industry leaders, and some of these guys are talking about, we think there's certainly going to be a short-term hiccup this spring and summer because we know what's going on, right?
Right.
And some of the investors I speak to and some of the guys at wholesale properties, we kind of are already seeing some things where properties are becoming available for real estate investors that weren't available before, just because if somebody was teetering before and they own a couple properties, they might just dump one. So we do think we're going to see a short-term hiccup over the next 6 months, but the forecasts say that for the next 6 or 7 years, we're going to have a very strong real estate market. And then in 2026 and 2027, because of the demographics of how many people we have in society, the forecast says that it's going to then start to take a slowdown then. So I definitely think this year is going to be tricky. I think there's going to be good deals to be had. I think that even at the same price, with interest rates 0.5 point or 0.75 point lower, that's good buying power for someone looking for a home.
I mean, Frank, what we're seeing is that there's a pent up buyers, a lot of them coming from Manhattan or coming from the Bronx, who are all looking out for houses in the suburbs, right? So we have a lot of buyers, but not a lot of houses because sellers are not comfortable with people coming to their house yet. So we're seeing that demand is high, right? Inventory is low, partially because of COVID, and partially because people are just unsure of the economy right now. So I think pricing is going to stay somewhat stable unless we have a flood of houses coming on the market.
Yeah, 100%. Well, let me talk about appraisals real quick because this may make the realtors and the sellers a little bit more comfortable. I'm getting a lot of appraisal waivers and a lot of appraisal drive-bys. Okay, so what that means is if somebody puts 20% down or more on a conventional loan, appraisal waiver every time. So don't have to come in the house. We're doing a desktop AVM. Fannie Freddie reads the value. We're good. If it's an FHA loan, they do have to go in the house. Okay, so with FHA loans, appraiser comes in with gloves and masks. They try and stay as safe as they can. There even have been, I've seen some 90% loans who've gotten appraisal waivers and or drive-bys. So a large percentage of these conventional loans don't even need interior appraisals right now, which is a real good thing.
And is that working for refinancing as well, or refinancing needs their full appraisal?
Yeah, refinancing's been unbelievable. It's so great because the biggest problem we've had with refis in the last year is the appraisers are so busy that from order to completion, it's 2 weeks.
Right.
And that slows us down. All day long, every day, we're putting in 3, 4, 5 loans a day. 75, 80% of them are appraisal waivers. The only time they're not appraisal waivers is when someone wants to take cash out.
Right.
So the Fannie system looks at that and says, well, if you want to take cash, I got to make sure that the value is there.
Right.
So a large percentage of our loans are appraisal waivers and or drive-bys.
Interesting.
Yeah. So that's a huge, and we were getting them before, but Fannie Mae tweaked it to be much more flexible. I had one yesterday. The person put 10 or 15% down 2 years ago. I was, I just went on Zillow or whatever, and I was like, I think the house is worth like $550. It's going to be close. We'll probably need an appraisal. And the AVM read 600, and now the loan is a 75% loan to value, and I got a waiver.
Wow.
So all this stuff we've talked about, there's been, what we've heard is that there's been a strangling a little bit on jumbos. Talk a little bit about jumbos, and then we can get into non-QM a little bit if you can. Yeah,
that's a great question. So the jumbo loans have always been weird, really, literally for the last 10 years because it's controlled by the big lenders. So there's a big disparity right now in lending that hasn't been around for a while in that, you have big banks, you have brokers, you have correspondent lenders, and then you have mortgage bankers who are Fannie, Freddie, Ginnie Direct. So whenever the big banks control something, we have a problem because they're conservative, they're disorganized. Honestly speaking, I have a great mortgage business because the big banks are terrible. And I'm grateful for that because if they were very good at what they did, everybody would go to Chase, B of A, or Wells.
Right.
They need me because they're terrible. So what happened was, like, we as a company were selling to Wells and Chase on our jumbos. And Wells and Chase came to the owner of my company 6 weeks ago, 5 weeks ago, and says, we can't guarantee that we're going to buy these loans from you. So what did the owner of my company do? Hold jumbos. Not doing them. Because if we can't sell them, we have a problem. Right. Now, in New Jersey, we're lucky, or New York too, on a single family residence, Fannie Mae high balance goes up to 766 loan amount. So we can do 766 all day long. That's the majority of the loans. That's a good majority of the loans. So go back to the equal or unequal playing field. The big banks don't want the loans. Chase just went to 700 credit minimum. That's ridiculous. You mean if somebody's got a 698, you won't do the loan? What if they have 500 grand in the bank? They won't even talk to them.
Wow.
So I'll take all those loans. Thank you very much. The brokers have to sell to the big banks because they're brokers. They can't write their own paper. So they're kind of in trouble. And even the correspondent lenders, the definition of a correspondent lender is they have an underwriter, but they're not allowed to service the loan because they don't have that designation. So the correspondent lender has to sell to a middle tier aggregator like a Home Point or a Caliber or a AmeriHome. Right. They're kind of screwed because they don't want the loan. But the Fannie, Freddie, Ginnie Direct lenders like us, which goes up to 766 on a single family, 880 on a 2-family, 960 on a 2-family. We sell directly to Fannie, Freddie, Ginnie, and we're good. So jumbos, problem. Anything below 766, Fannie, Freddie, Ginnie direct lenders are in great shape to help people.
Okay. All right.
So it's worse in Florida because Florida stops at 510 loan amount. So you have areas like Sarasota where the average house might be 700. People want to borrow 650, and that's technically a jumbo, right? Because the high balance limit is different in each county. So New Jersey, New York, California, very large. Parts of the country are a little different.
Right.
Okay. All right. So there's the phrase out there, non-QM loans, and talk about what they are and how that's affected in this day and age that we're living in.
So you guys, Dave, you've been to my seminar, right? And I talk about, and I've said it in Jersey City. I said to the people, and there was 200 people in the room, and I said, guys, these products have not been around for a long time, and they're not going to stay around forever. And people, just get used to what you have. Well, I was talking about loans like a debt service loan for a real estate investor. If they put 20% down on a loan, it just has to carry itself. They don't even have to show any tax returns. A business bank statement loan for the plumber who brings in $20,000 a month, so has the deposits, but only shows 30 grand a year in income. We can just use his bank statements. All of these loans literally got frozen 5 weeks ago because of COVID, and the entire industry is in a non-QM shutdown. So basically, it's similar to 2008, where we went back to, and the government was trying to get away from this. The government wanted more private lending. They wanted more hedge funds to come in, and that was sort of the non-QM world. So when the hedge funds look at this and go, yeah, the rate's higher. If I can lend at 6%, right, and I got a yield or a bond at 3%, I can make my money. Great, but when there's uncertainty in the marketplace, right, the flexible loans, non-QM, went away like that. They went away.
QM stands for people that don't know?
Qualified mortgage. So qualified mortgage is a mortgage that can be verified through income tax returns. So the qualified mortgages are the conventional loans and the FHA loans, which are governed by the regulatory bodies. So I said to everybody, it's not going to last forever. You better jump on it now. And now listen, it may not go away forever, but we need stabilization in the market, right? In 2008, when all of that stuff went on, the American collateral for the first time in how many ever years was unstable, right? So the only people lending were Fannie, Freddie, Ginnie, and at that time, Fannie and Freddie were private companies that the government had to take over. They were quasi-government agencies. The government had to take them over, and then the government had to buy bonds. And in 2009, they came out with the HARP loans for people that were upside down on their mortgages, and they lent to people that had Fannie or Freddie loans just so that they can get them better rates so they can get back in an equity position. Right. So this took literally 10 years. And now America's back in a good equity position. As I mentioned, it's an average of 75% loan to value in America, which is wonderful.
Pretty good.
It is. It's pretty good. And we don't want to lose that. So it's not the same as 2008 in the fact that we're still in a good equity position as an economy, right? So then everybody was upside down. We were doing 110% loan to value. Right. So we're okay there. We just have to get past this short-term hiccup. And that's why the forbearance thing is sensitive to me, because I'm like, if you can make your payment, make your payment. Only if you're flat broke and you have no choice, should you consider forbearance.
Right. Okay. I think people are choosing forbearance because they're choosing to use their money somewhere else where they feel is more important than their mortgage. And that's really what it comes down to. At the end of the day, pay your mortgage if you can, and, sacrifice something else, not food for your family, but, there are people spending money on other things right now that just don't need to be spent on.
Yeah, 100%. So, there's so much that's gone on week to week that I started doing Facebook Lives once a week just because it was a wild roller coaster. And I would speak to somebody on a Thursday, and you don't want to sound salesy, right? You want to be like, you should apply right now. Because then they think you're like selling them. What's it going to take for you to walk out of the dealership today with a car? But I would say, listen, I'm telling you right now.
Yeah.
Go from 3 1/4 to 3 3/4 in a day. So 6 Fridays ago or 5 Fridays ago, my wife and I were going to Miami right before the COVID thing got crazy. And I was literally like nearly in tears. We were having a drink and I was nearly in tears because like 25 people that I had spoken to about low threes went away like that. It went from 3 1/8 to 3 3/4 in 2 days. And they'd call me Monday. I'm ready to go. Too late, we missed it. But then like Barry Habib and MBS Highway, they were like, listen, guys, government's going to buy bonds, rates are going to come back down, take the apps from everybody, get them teed up, and when you're ready, lock them. So that's what I did. I got literally 99% of them back, and over the next sort of 5 weeks, it trickled back down. It did a little bumpiness, but we've gotten everybody back to the stable point. We missed sort of the best Friday 6 weeks ago, where I got people 3%, 30-year fixed, crazy. That went away. Now it's more like 3 1/8, 3 1/4, but it's still ridiculous. The funny part is when somebody's at 4 1/2, I'll be like, rates are 3 1/4 right now. I could save you $400 a month. I could save you $196,000 off the life of your loan if you follow my strategy. And they'll be like, I want to wait for 3. I'm like, wait. You're going to jeopardize $410 a month savings just to save $430? Like people are a little goofy. I mean, no offense to the public, but like let me just do the math for you. And by the way, you're not in the mortgage business. Trust me, I'm going to give you the math. Oh, and by the way, our company has a free float down if rates get 1/4 better. So if I lock somebody at 3 1/4 and they go to 3, I can float them down for free. So there's no risk.
Frank, we see that in real estate, right? We have a buyer, right? The house is asking $550. Like, oh, we're only going to offer $500. Right, we're down to the sellers are at $520 and the buyers are at $500. I'm okay, guys. Let's meet in the middle. We're talking $10,000. What does that come out in a mortgage payment? Right. We're talking about $9 a month, $12 a month, something like that. Like
6-pack and a beer.
People don't get it that like they're making a decision based on an overall purchase price of the house when they're not looking at their monthly payment where they can get the house for an extra $9 a month. They can have the house that they want, but they're going to pass on it because they can't get it for $500, only for $510.
Cost versus price.
Well, it's not. You're not buying a car, right? That's what I say.
You're not buying a car. Absolutely.
You're not buying a car. We're not talking about. I mean, you have fun at the car dealers. You're like, dude, you got to be $6 a month lower. Like, come on.
It's true.
But your martini costs $16 that you just got last night.
It's wild. So Frank, we're coming up against time. What can we do to help you in your business? We know you've got several programs out there. The Velocity of Money, 3, 2, 1 and done. Thank you so much for coming on. What can we do to help you grow?
Well, I just have a heart for helping as many people as possible, and I'm passionate about doing an analysis for people on their mortgage. All they have to do is show me their mortgage statement, tell me what their current balance, what their initial, literally show me a mortgage statement. I do some math for them, and it's like going to the doctor. Worst case scenario with me, I would say you're in good shape. You don't need to do anything. But best case scenario is we help them save. It's usually over $100,000 in savings. So I say to people, if you could save 20 or 25% on your interest rate, you can go from 4 1/4 to 3 1/4 or 4 1/2 to 3. That is going to be $100,000 to $200,000 in savings. Don't mess with that. You'll nickel and dime somebody at Kohl's to save $6, but you're waiting for the extra 8. So I want people to just open their eyes and realize this is a silver lining, and we want to help 1,000 families this year refinance their homes.
Awesome. Frank, thank you so much for coming. This is Frank Dippold from Vandyk Mortgage. Thanks.
Frank, that was awesome information. Hopefully our viewers will call you. How do they reach out to you? What's the best way to get in touch with you? fdippold@vandykmortgage.com, or easier, just give me a shout at 973-214-3945. Awesome. I want to wish everyone a great weekend. Try to enjoy yourselves. We'll see you back here Monday morning. We have a lot of great guests next week, so definitely tune in.
Great. Thank you.
Thanks, guys.